Good morning, folks. All right, so we're going to be looking at the non-farm payroll employment change. This is the monthly carnival ride that I tell you all to avoid. So we're going to be looking at the dollar index on the left-hand side. It's a 1-hour chart. And the euro dollar on the right-hand side, that's an hourly chart. So we'll take this lipstick off. Okay, it's traded down into the levels that I was looking for, traded up into the respective levels on the dollar. All right, so we are looking at what the draw on liquidity is going to be for dollar and euro. And that's the only extent, I think, for study purposes you would have for watching or observing non-farm payroll, just simply for the purposes of liquidity. So I'm going to map out this volume imbalance here on the dollar. Draw that out in time. Okay, and that's where I think it's going to draw down to. And if you look at the range that's been created with the first day of the week, and over here on euro, I think we'll trade up into this. This, I think, will be the manipulation. In other words, it should shoot up into that for euro and shoot down into its respective volume imbalance on the dollar index. Now, once it does that, I think it will try to go higher for dollar and go lower for euro. It's unsure to me whether or not it's going to break the dealing range lows on euro at the first trading day of December. The high on the dealing range created on the dollar index, I don't know if it's going to run through that either, but I do believe that's going to act as a draw on liquidity. So the weekly low outside of the dealing range that was created with that wild whipsaw price action move on the Powell first speech that he did on Tuesday, that range is what we're trading inside of. So it makes it a little bit more difficult for trending models for sustained price swings. So you have to look at it from a small scalper and liquidity trader. In other words, you're looking for opposing liquidity and not trying to capture these big extrapolated price moves. You're not trying to win a lottery with your trading. You're just trying to get bread and butter type setups. Now, I'm going to do my best this morning to outline what I believe my concepts illustrate and the logic and the narrative. Now, the narrative here is we've seen the dollar index make a low this week and trade off of that 95.51 level. So we've been bullish all week. I believe that traders that are already long dollar are going to get removed today, and they're going to trade down into that volume imbalance. Once it trades down to that volume imbalance at the 96 big figure, just below it maybe, I believe that they will run back higher than the high that's already formed for today. So in other words, it's going to take out London's high or Friday's at present near-term intraday high. Now, will we continue to run all the way up in through the high that was formed on Tuesday? That I don't know, and I don't care to know, okay? If it were any other day other than non-farm payroll, I would look for that continuation higher on the dollar, and I've been bullish dollar. I've said I haven't abandoned the higher time frame narrative that dollar's bullish, and we're not trying to pick a top. Now, everything what I just said there, we reverse that for euro dollar. All right, and I'm going to highlight the dealing range levels here. We'll put that in dash line that, get a little bit thicker. All right, and we'll do the same thing for the dealing range low for the week. Here. All right, so that's our dealing range we're trading within. And we'll do the same thing for euro dollar. Dealing range high and dealing range low. All right, so in short, I believe that we're going to drive towards and draw on the high of the dollar and the low of euro. And for accountability purposes, because some of you think I'm blowing accounts still. Nothing's been done. I'm doing exactly what I told you to do. Sit still. Don't execute. Just practice. Observe, log, and screen capture things that are noteworthy. All right, so back to the narrative, because I want to talk about that. Narrative is that we don't need that range to break on either euro or dollar. But the bias, okay, is higher dollar, lower euro. And I believe, you can see me here doing the very obvious idea and narrative. It's going down, then draw up towards that level right here. Okay? Now, that's the narrative. That is not the absolute delivery of price. It's going to go to 96.64. Okay, that's not what I'm suggesting here. Can it do it? Yeah. But I'm showing you with euro that I believe is going to go up into that fair value gap in the form of sell side imbalance, buy side inefficiency, and then gravitate towards the dealing range low. So that way, before non-farm payroll even starts its gears turning, that is what I have in mind. Okay, this is what I would expect. Please do not take this as enticement or encouragement or a lure to think that, yeah, ICT's concepts are going to let me be able to go in here and trade non-farm payroll. He says not to do it, but really that's a secret password, laced, go do it. That's what I really mean. No, it's not what I mean. I want you to stay away from it, because if I do this every month going forward, you're going to see eventually I get it wrong, because it's just a squirrely type of event where they go in manually and mess it all up. So from an algorithmic stance, that's what I'm looking for. I'm looking for a drop down into that 96 or just below $1, then rally higher, take out the intraday high. Okay, right now the intraday high is formed in London for dollar, and the low is formed on euro in London. I believe that right now dollar should not go higher than it has. I think it'll just quickly reprice lower down into that fair value gap or shaded area on the chart on the left. Okay, so that volume imbalance, that is your discount array. Okay, so the discount array for dollar sets up a run higher after it trades there. So you would have, not that we trade the dollar index, but you would wait for the dollar to trade down there, and then you would look to the euro to go short. Preferably, it would be in its premium array or sell side imbalance, buy side inefficiency. So we would like to see it trading around that best case scenario would be like 113.30 or just above 113.30, thereabouts. And at that moment, the dollar would be in its discount and the euro would be in its premium, with the narrative that the dollar will move higher after going down into its volume imbalance at 96 or a little bit less, and the euro will go lower after trading up into the 113.30, or maybe even the consequent encroachment between, I guess it would be what, 113.25, we'll call it, 113.26 there in that vicinity. So, but we have to wait to see how price delivers. Okay, that's the part that's a little bit of a gray area. You never really know what you're doing until you start watching live data. Okay, and I got a lot of feedback through email, and people are, creating threads in their respective groups saying that they enjoy these tape reading. This is some of the things I promised once you start getting closer towards charter level, because you're actually seeing the mechanics of what it is that we are looking for and how the market reacts to them. And yes, you can forecast, and yes, you can predict, and you can see these things forming. They won't form always 100% accuracy, but clearly, this is my third day here, so we'll see what the results are today, because, it's non-farm payroll. I'm not putting any kind of wager on me being correct. And in fact, it's probably better. Let me just say that right now. It's probably better if this fails. In other words, the narrative I'm outlining right here, if this fails, that will do more to justify why I tell you do not trade non-farm payroll. But the flip side of that coin is if it does exactly what I'm suggesting here, don't read into that as an enticement for you to say, see, that's what he's doing. He's really saying, do it, but doesn't want to draw any special attention beyond that. It's not code words for you to go in and trade non-farm payroll. Please just don't ever do it. Don't ever trade non-farm payroll, period. End of story, don't do it, okay? So, with that in mind, I want you to keep this narrative in mind. So when I drop down to the lower time frame charts, don't lose sight of this framework. Dollar drops down to 96 or just below it, then trades higher to take out an intraday high. And it makes a higher high on Friday, gravitating towards in the direction of the dealing range high at 96.64 and 2 pipettes. Euro should trade up into its sell side imbalance, buy side inefficiency, and trade around that 113.30 best case scenario, but we'll see how it trades. It might only just go up into consequent encroachment. And then sell off, running out the intraday low that was formed in London, then gravitate towards that discount low and dealing range low of 112.35 and 2 pipettes, if my eyes are not failing me. The scenario would be, and narrative would be made void if, now this is important, it's crucial information, if the dollar makes a higher high on non-farm payroll release at 8:30. So if it does that initially and takes out that high, what I just stated here is not a factor for narrative or the basis for a narrative, let's say it that way. In other words, for it to drop down after it makes a higher high, that is not bullish. So we want to leave the low resistance liquidity run signatures that's in play right now on dollar. Notice that we have the London high and the lower short-term high we're at right now. So I'm going to drop down into a lower time frame 30-minute chart. Look for some refinement in the levels. Euro looks, it could be reduced. I can reduce the the fair value gap on Euro can be one of two things. I like the range that's in right now. You know, the shaded area I put on the right chart. So I like it running just above that 113.30 level, but just for the purposes of just refinement, you know, that right there is enough. Okay, so it can trade up into that level right there, that fair value gap, but just know that it could trade based on the hourly chart. You could trade as much as the 113.30, maybe 32, 33-ish. Because there's a small little imbalance above the one I'm showing here on the 30-minute chart. So, typically, what you'll see on non-farm payroll is whoever's making money right now, like say overnight or the last few days, non-farm payroll will typically make a run against those profitable traders that are on side at the moment. And in that instance, when we look at the dollar index on the left-hand side, you can clearly see the longs have been bullish. And not just bullish, but profitable. They will get attacked. The algorithm will make a sudden run right for a clear and obvious discount area. It's not a support and resistance zone. Notice that volume imbalance, if it trades down into that, that is algorithmic. It's going down there to upset the long holders because there's several areas in here where the dollar on the left-hand side, you know, well, look at the 96.13 and 6 pipettes level. You know, what do you think a retail trader is seeing here? They think that's resistance broken. Now it's acting as support, right? So they think that the market has come down, found support, starting to go up now, and because they don't know how to trade, they're going to chase it. And they want to do what? They want to be buying it because they see it's been going up. So it's been going up, and then they see it's bounced off of a level that would be seen as resistance broken, now turned support. That's flawed logic, but nonetheless, that's what it is that they're anticipating. So they will destroy that perspective, run on the liquidity that's offered below those lows, and go to where the algorithm is programmed to reach for, which is that volume imbalance right there. Okay, so I'm going to highlight this and put on our little annotation. This is retail support. Oops. And there we go. There we go. And make it, oh, gotta make it darker. Sorry. All right, and we'll make it bold. Make it bigger. All right, so retail sees support right here, and right there on that low. So that's what they're anticipating and looking for higher prices. The reverse would be seen and expected with the euro dollar. So if support's being perceived in price action for the dollar, the opposite would be seen on euro. So we would expect resistance to be offered here, but I'm going to just label it as the buy stops on short holders. And they want to get short now because they see dollar at a supposed retail support line. So they want to go short on euro. So if they're going short now, they're chasing it. Their books tell them to find the high that it recently formed and place a protective buy stop above that. And it's a little too big. Let me reduce that. And yeah, see that it's good enough. It might not be that clear for you, but it's enough for you guys to see what's going on. All right, and that's what we're looking for the liquidity points for dollar and euro. Okay, so let's see how long. Oop, just spelled it. Let me get that N out of there. All right. Nope, I can't see it. No, here we go. We have non-farm payroll releasing. Put this where you guys can see it. Already, right away, euro has ran up into and above. It went to that 113.30 level. So again, that hourly chart I mentioned that was likely to be a factor. Dollar has yet to go down to its volume imbalance yet. So that's what we're looking for. That would key up the opportunity that would spell a short on euro. So far, dollar's delivering beautifully. Look at that. Perfect, perfect, perfect delivery. And just above the 113.30 level, like I was mentioning, on the hourly chart, we're just below the discount low of the fair value gap on, I'm sorry, the volume imbalance on the dollar index. We want to see it kind of stay inside that. We don't want to see it break below that and expand. Ouch. They never learn. Just because I like to add that little bit of a sting and twist the blade. All right, so we've come off the discount low on the dollar index volume imbalance. Just like magic. All right, so you can see these are comments and things I'm sharing with you, not only audibly, but in text. I'm typing it in, so it's not me looking at multiple screens. I don't know how I would do this if I was doing it multiple screens. I'm doing two different narratives now, so I'm speeding it up now. And we've seen the market rally up, come off of the volume imbalance on the dollar index, and now we have a wick forming on the euro. Okay, so now this is a potential bearish breaker on the euro dollar, and there's a sell-side liquidity pool I've outlined here, and we'll drop down to a 5-minute chart on both. So I've given you a consequent encouragement on the wick on the dollar index. That would be a long there, and notice I'm anchored right to the candle. I believe we're going to see the beginning of the move back up into that 96.32 and 1 pip at running the buy side. Euro would be a short aiming for the liquidity below 112.88, and then ultimately trading below the 112.82.9. Nice reaction on the dollar index. Focus is here on the highs on dollar. Short-term high that it's approaching now, that would be the initial target, and that would match up with the sell side liquidity that's being outlined on the euro on the left. I'm sorry, on the right-hand side. But ultimately, we're looking for a complete breakdown of the daily high and the daily low, respectively, for dollar and euro. All right, we are in a bearish order block for euro dollar, so it should be done going higher. There you go. Here's your bearish order block. Mean threshold traded to right now in euro. It should start going lower. Bullish order block on dollar on the left-hand side. It should start to move higher and accumulate. Nice reaction so far on both dollar bullish and bearish on euro. All right, so it's been more than 30 minutes since the non-farm payroll numbers have been released on the market, and algorithms will start using the liquidity. And here we have a short-term little, there it is, there's the run right there. So you would take partials there on your short on euro, and you would want to see dollar index want to expand higher. Now, we just had a pool of liquidity tagged, so, and there's a small little imbalance that we're coming back up into now. So that's normal. We'd like to see that gap left there on euro, but because it's non-farm payroll, it could fill it and trade deeper into that bearish order block. That's what makes non-farm payroll a little less pristine, okay? Not as clean as a normal trading day. It's a lot of noise and chaff that gets put in on this particular day. Lots of manual interventions. All right, we're seeing reaccumulation on the dollar index here, trading back down to its bullish order block. And we're approaching an hour mark, and typically after an hour non-farm payrolls release, there's usually like this period of quietness and time distortion kicks in. So it can be a little muddy, but then the last bit of the morning move will form. And right now we're looking for that run into the 96.32 for buy stops on dollar, and we're looking for 12.82 to get blown out on euro dollar. Okay, and we're seeing some consolidation, choppiness in here. Overall, narrative is still good. Nothing in here has changed or upset the underlying bullishness on dollar and bearishness on euro. We would expect a expansion lower and snap lower for euro and dig into the sell stops. Okay, we just need a lower low, so that would be a period where you could take out another partial because we're running down equity. So you could take a partial there. And remember that premium high on the dealing range for the week. That's where we're drawing up to on the dollar. Small little retracement on euro dollar. That would be a sell right there. And you would use the rejection block at around the 113 big figure as a stop. And all the commentary I'm trying to give you, I'm trying to read it also, so it's not easy to it's not easy to do these and set them up narrative wise. And then when the charts, there we go, nice drive down lower. So there's your delivery on both the buy stops on dollar and sell stops on euro dollar. Hopefully this has been insightful. Again, do not use it as an enticement to trade non-farm payroll. All right, folks, we are looking at the aftermath of the non-farm payroll. And I just want to throw a couple little bullet points on. It's very difficult to watch the price as it's delivering, then anticipate what you're probably thinking, questioning, what concerns you may have, and also me trying to take your attention to the things that are most salient, most important at the time. So I don't think I did a good enough job as I was looking at the playback for the video that I'm showing, obviously the commentary and mapping it all out before it happens. I didn't do a good job of telling you where the entry is down here on the dollar and the entry up here. So you see me real quick because the video gets sped up, but I do this where I'm taking the wick here, or the tail, and I'm measuring where the 50% is, where it is consequent encroachment. Okay, and that's why I dropped that line there. So when the market creates that run down into it here, that's where it should stop. Now it goes through it a little bit, and that's okay, it's permissible. But the next candle, that's where you would enter. If you're not entering right there on that run into it, that's where you would enter on consequent encroachment. Now, the reason why you would do that, and why I teach you the gap in the wicks is being referred to by the algorithm. The market has already done what here? It's trading down into that volume imbalance that's on the hourly chart. So it's already traded down into its discount array, then came off of it sharply and closed this candle right there. The next candle opens, trades down into consequent encroachment, which is the midpoint of that tail. Once it does that, that's where you would be buying with the narrative that I outlined before non-farm payroll even hit the market. So we're looking for it to run above this high over here. Okay, so all of the buy stops and the intraday high, that's going to be targeted. But they're going to drop it down to upset those that are long so they can't get out there. And it also induces new sellers so that way they can pick up more buying here with counterparty to their longs that they can offset here to the buy stops they're going to sell to above the daily high. So it's hard it's hard to articulate every single thing when live data is coming, okay? And it's great in a lot of ways because you guys get to see it, you get to look over my shoulder, and unfortunately, because I'm processing, I'm thinking, I'm processing, I'm trying to read what the price is showing, what the algorithm is likely to do, and also I want to be, I guess, predictive in the sense that I want to show you that I know what you're thinking and what you're probably concerning yourself with at the moment. But I didn't really do a good enough job to talk about this. But this has not been form fitted. You know, I teach you the consequent encroachment of a wick and a tail. That's going to be a likely level to trade back down into. But you use it as an entry technique once it has traded down to its discount array and you're bullish. This was the initial whiplash that comes in because of non-farm payroll. See at 8:30. Then we open on this candle here and we trade down one more time. Everyone else is going to want to see it keep going down. But we looked at that level right here, mapped it out before it even formed. Traded down into it. Yeah, you know, this is the type of thing that kind of irritates me because this run through probably wouldn't happen if it was non-farm payroll. But because non-farm payroll, everything's exaggerated. Like everything is muddied and it just makes it difficult. Now let's take this whole idea and apply it over here on the euro because we don't trade the dollar obviously. So we're going to look at the euro and how would the entry pattern be used on this. Now again, I'm not doing this so that way you trade non-farm payroll. That's not the gist of what it is that I'm doing here. But here is the 113.20 and 1 pipette. And then it closes down here. The next candle opens and trades right up into consequent encroachment. That would be your entry point. Okay, and also notice what it's doing. It goes right back up into discount low of the fair value gap. Hits it almost consequent encroachment if my eyes are correct. looks like it just fell short of it, but it's still good enough for government work. Then that would be your short. Where would your stop be? Above here. Oh, that's too big of a stop. Well, that's what you're going to need on a day like this. It can pass through this one more time because of the nature of that day. Non-farm payroll flies against the normalcy of the markets. It just does things that are just uncharacteristic, which is why probabilities are much lower. Despite me showing you that we can outline it, define it, and frame an idea, it doesn't mean go in here and start trading it. Then we had the bearish order block here. It trades up into that mean threshold, breaks down, comes right back up in mean threshold of this last up close candle as well, and the low of the up candle here. That's your bearish order block, hits it there, and then that time distortion I mentioned that usually comes in. Then it breaks lower, comes back up in mean threshold, breaks again aggressively, leave the gap. We want that. Come up, doesn't even give you institutional order flow entry drill, which is good. That means it's really heavy, and then presses into the sell side. Okay, and that's what we were looking for. In the direction of that old dealing range low. In the direction of the dealing range high on dollar index. Once it did what we were looking for, now we're back inside the range again. Same thing here, back inside the range. All right, so with that, I just wanted to toss that in there, and now I'll give you the weekend commentary, which will be brief. And hopefully you guys enjoyed the last 3 days. I'm not going to do this every single day, folks. I just did it to kind of like spice up the commentaries, because most of you were very, very patient with me when I was going through surgery, and I wasn't able to put anything up for a couple of days. So I'm trying to give you some added value. Also, answer some of the people that were looking for this type of thing. They want to see it. And I can throw a couple of them in each week, but as a steady diet, it would make the videos much longer. And remember, I have content I got to complete. Like, I have to deliver by February. That's my timeline. So I'm taking the month of March off, so I won't be giving you any videos. I won't be on YouTube. But then April, we'll resume again with teachings. I'm not completely done. We're just going to refine and kind of like over the shoulder type things going forward in April. And then we'll see what we can do there. I've tried to come up with a way where I can do live sessions that are private to just us. But it's really, really expensive. Like, really expensive to have a group like us and do live. And I don't want to do it on YouTube because YouTube will be abused. There's no way for me to secure it, not that I'm aware of. But I might do YouTube and just keep things just generic. Like, here's the direction, here's this. And then fill in the gaps that would obviously be in YouTube live streams. Kind of like what you just watched me do with the last 3 days here. Obviously without all these details. But I would just say, I think it's going to go up here. I think it's going to go down there. Which is kind of like if you're going to be doing like a signal service. You do not want to be doing this. Like mapping out where the consequent encroachment is and then using that as an entry. Like, that's high-end stuff. You might look at it as like, oh, whatever. But that's high-end. Like, this is interbank level. That's an entry technique used by interbank traders. You don't see that in books. You don't see that in no other educator talks about that. Okay, and it doesn't happen because until I talked about it and revealed it, it was never known outside of interbank trading. So unless you've been selected to be one of those individuals, and that's how it works, you just don't apply for it. Okay, there's no job openings. There's no LinkedIn or I haven't even had a job long enough to know what do people use to get jobs, like to post their resume. I can't think of anything. Well, you know what I'm saying. Like, there's no job listings for it, no help wanted for an interbank trader. Like, they hand select you. It may be that you have done something at a firm, at a trading brokerage firm, and that has been done in the past, where if you do exceptional trading and you're really good with management of money. They're not looking for somebody that runs the account out really hard and really fast and the Olympic size returns. What they're looking for is impeccable risk management, placement of entry, stop management, not a lot of trading, very methodical. Those people through brokerage firms can be scouted, and I'm not suggesting that you would be selected that way, but it has been selected in the past like that. But usually you're a standout person, some way, shape, or form. You're set apart, and if they're interested in you, they will obviously make it known. But if not, then it is what it is. You can't draw attention to yourself any other way to say, hey, come use me. It doesn't work like that. So, and some of you in here just deny that that's even a real thing, and that's fine. Whatever. I'm not here to try to make you believe everything I tell you. You just take what works for you. Okay. If you don't want to hear about my origin, you don't want to know all the details or my personal life, whatever, but I'm going to be me. I'm not going to be fake about anything. This is me. So when you're doing signal services, okay, or if you're teaching and calling moves in your I guess services that you're offering for analysis or whatever, to stay compliant with me, don't give the details with that. Now, how would you do it where you're going to blow their socks off and they won't understand how you did it? Well, you can use the measurement you would do. You can do this on another chart. Don't let them see you doing it, because all you do is drop a fib on here, on this close down to that low, and they see you pick the 50% level. That's it. They figured it out. They won't understand the logic the first couple times you do it, but given enough time, they will. And then if you're trying to run a service like that for an income stream, you're basically just going to give away the draw on you as a resource. So they won't need that anymore. Now, there's nothing wrong with that. If you're trying to teach how to trust you, okay, and you want to show them that you can see things happening, you just put a level in here, just maybe above 50%. Okay, try to do it like eyeballing it. And this looks like a good level right there. Okay, and when it goes down into that level, you would say, okay, it's a buy right here. You're not telling them that it's going down to this volume imbalance. You just know that it went down here, it spiked, came off, and now you're just looking for a failure swing. And that's how you could do it. I wouldn't have any problem with that. You would not be at odds with me. You would not be violating any agreement teaching my stuff. But imagine, without all the details that you see me do on the markup and the live over the shoulder with the dollar and euro, if I just would have said the levels and gave you no teaching as to why this is what it is, you would be like, man, this is mysterious. This is really interesting. And that allure, okay, that allure will keep the people that come to people that offer services. They're never going to learn how to trade. Okay, they're never going to learn how to trade. If they came to you or anyone else that has signals, they're never going to learn how to trade. So in my mind, I don't view it as being disingenuous or providing a disservice to someone like that by not giving them the details as to what you're doing, because you're not promising them how you're doing it. You're telling them what you think is going to happen based on your interpretation of price. So if you have that aspiration and you want to go out there and you want to, I don't know, maybe you want to do a funded account, get funded, make money that way, bankroll yourself, then after you've been consistently profitable and you've done very well for yourself, you can use your funded account to give yourself your own funds to build up a live account there. So that way you could show that I use this information that I trade with to get funded. There's no shame in that. Then you made money from that and you're trading in a live account or accounts, plural, and you can show that track record. And then say, okay, now because I've proven that I am profitable, I've proven a track record, and I showed you that I came up from nothing. I don't mean that to be disrespectful, but you grassroots level, you built yourself up, and now you have the funded account as a means of income. You have your live trading accounts as a means of income, and then you do a signal service, which you can do 2 or 3 trades at most, probably for a week, and that would satisfy most traders that don't want to trade. And if you don't give them the details, not only will they feel like they have struck oil with you because you are giving them the things that are panning out in the marketplace more times than not. Notice how I did that? Because nobody's perfect. I'm not perfect. You're not going to be perfect. But never sell yourself on ridiculous levels, like of precision or whatever. Let those individuals see you operate and let them come to their own conclusion. And if you give like a 30-day trial, say, hey, look, you're welcome to come in, watch me do this. And for 30 days, it's an open house. Anybody can come in. Don't even register your email address. Don't even do any of that stuff, because to do that, they're going to think, oh, you're going to look this spam email box. You're going to do this, do that. Make yourself absolutely transparent if you're going to do a signal service. And don't give them these types of levels. Not only because you won't violate our agreement, you won't basically screw yourself, because if you do this, see, some of the younger guys that have taken my content through leaked videos or whatever, they're making YouTube videos and they're putting my stuff in their videos because they know people are going to see that and they're going to know, oh yeah, he's been trained by ICT. That's cool, but I don't want any of you thinking that that's going to lead to long-term success for you. If people see you doing that, you're just going to be like a conduit just back to me. So if you're running a signal service, you don't want anything with me attached to it. You want to do it on your own steam. Don't do any kind of markups in your video. Just say, this is where it's at right now, and this is where it's going. And you put a level, horizontal levels on it. That's it. And I promise you, everyone that subscribes to you that doesn't want to learn how to trade or can't do it, it's not a disservice to them for you not to teach it. Keep it mystical. Keep it, mysterious. And they will love you for it. It'll keep them engaged, and they will talk about you. And that will be advertisement that you don't pay for. And then they'll bring more people in there for you. And there's another income stream for you. That is not, no, you don't need any affiliation with me for that. That's your own operation. That's your own enterprise. But just don't give them the details, because they're not entitled to it. Okay? So anyway, real quick, we're going to go out to a daily chart on the dollar index. We have made a short-term swing low. We want to see if it wants to press higher. It needs to get through the imbalance here and go through that. I'd like to see it come back down and find the premium high support and then run into that weekly imbalance that we've been mentioning. And on euro, I promised it would be real brief. There's not a lot of detail in here. Euro, we want to see it again, try to make an attempt to get down into here next week. That's what I'd like to see. If we take out this candle's high, we're going to look to trade into here, and everything I just outlined on dollar will not likely happen. But we're looking for continuation on euro going lower. And on cable, this thing just keeps digging in. I mentioned that it's really not clear as to what it's reaching for. There's no imbalance in here, just liquidity pool there. And these right here, which could be really interesting if it starts to get higher on dollar. That's a good distance away, but it could do it. I just don't know. I just know it's heavy, it's weak on pound, and there's that. And last bit of business. Nasdaq. I mentioned the other day on the video there was an objective that if it got really, really overzealous on the downside, this would be like the best case scenario. And it looks like it might even do it today. Good grief. That's the imbalance right there. So if you watch that video, and I did the tape reading on, this is where I said this is the ultimate best case scenario. This is where it is. The framework is that imbalance there. Okay. Nice little imbalance it traded to, overshot it there, bearish order block, sells off. Beautiful, beautiful, beautiful price action. And imbalance, closed, boom. Here's my target. Look at that. it obviously, stopped me out. You saw that on the balance, but that's the business down here. Oh, doesn't show it on that time frame. Let me see if it was the 15-minute time frame that shows it. Yep, there it is. Best case objective. That's where it was. And again, it's that daily fair value gap that's way down there. Okay, so short, simple, just off the cuff today. I want to keep things real relaxed. Enjoy your weekend, folks. I will catch up with you again on Monday. And again, no reason to clog my email box up with the appreciation on these types of lessons. I promise you, we have really good stuff coming, way better than this. So I'll catch up with you on Monday. Be safe.